The benchmark US stock indices managed to stage a relief rally yesterday, gaining between 0.5% to 1.9% between the four major US stock indices. But however, this rally will stop short right exactly at their respective 50-day moving average, I think as key intermediate resistance due to a persistence of higher oil prices. The West Texas crude oil managed to end yesterday US session with a gain of around 1.6%, recording its third consecutive rally since the start of the US-Iran conflict, holding firmly above the 72 psychological US dollar per barrel on the West Texas crude oil. And in today's Asia session, it continues to extend its rally, gaining by 1.4% intraday as we are speaking on the West Texas crude oil. The US dollar ended lower yesterday, down by 0.3% on the US dollar index, but still holding above its key 200-day moving average. Very good morning to all and welcome back to today's Daily Dose of Market Insights. I'm Kelvin here. Today will be the Thursday, the 5th of March, 2026. So let's have a quick look at the disclaimer first. Leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is for general information purposes and is not investment advice. Past information is not representative of future results. Okay, so here we go. All right, so before we jump straight into the intraday update on the technical charts of all the broad-based cross asset classes that we cover on the frequent basis, let's have a recap what has taken shape so far in terms of news flow and relevant economic data release. All right, over here. Okay, let me switch my screen. Okay, good. So this was the end of the session of the US session yesterday. So what we could see is a broad-based rally across the board for the Russell, the Dow Jones, the Nasdaq, and as well as the S&P 500. So my apologies, the range was from 0.5% to 1.5%. So the weakest was the Dow Jones Industrial Average, up only 0.49%. And the strongest was the Nasdaq 100, up by 1.5%. So later I'll share with you the rally actually stopped short exactly at their relevant 50-day moving average, I think as key intermediate resistance. And that indeed saw profit taking in the Asia session as we are speaking right now, where both the E-mini futures is down by negative 0.17%. Trading at the session low at around 6,860 level for the S&P 500 E-mini futures, and as well as the Nasdaq 100 E-mini futures is down by a similar magnitude as well, negative 0.18%, trading near the session low as well at 25,085. So making those 50-day moving average as a key hurdle for the bulls to surpass. And one of the reasons why the bulls got a snapshot of their rally in today's Asia session was this particular news flow out from the US Senate. So yesterday, the US Senate, together with, with some of the Democrats, actually put down a vote regarding about the US President Trump war power itself. So overall, given the fact that the Republicans still hold a slim majority in the US Senate, it actually allows US President Trump to continue this ongoing US-Iran war without any definite timeline over here. So let me share you guys. Okay, so the US Senate cleared the way for US President Trump to continue military attacks on Iran in a vote that largely broke down along party lines. So this outcome allows the administration to proceed in the conflict with uncertain costs, consequences, and economic effects, despite the war commanding far less initial political support than the US war in Afghanistan and Iran. So with this Senate vote that allows Trump to hold on to his war power, automator's power on this war in Iran, giving him without a fixed timeline to end this war, and potentially it could drag on much longer, given the fact that based on those public speeches made by the current US White House administration and on Trump himself via his various social media posts, there doesn't seem to be a clear end game in sight to actually end this US-Iran conflict. And that being said itself could further potentially increase the risk of more oil disruption in the Middle East. And given the fact that if we start to see oil disruption in the Middle East, it will lead to elevated inflation costs. So how do we find out what market participants are viewing the risk of an oil supply disruption in the Middle East? Is to look at prediction market, Polymarket. So some of you know Polymarket is a rather controversial market where in the last few events, it managed to pick out bets as predicted correctly. So in last month, there was some traders who won a bet stating that US will stage a war on Iran or will attack Iran before March. And also earlier this year, there was also a bet some traders won where US will actually seize or remove Venezuela leader. So how do we look at this Polymarket bets? Is I will take a look at one of my favorite macroeconomic dashboard, which is by Macro Micro over here. So Macro Micro has this particular segment where they're able to look at they actually sieve out Polymarket, we call it website over here. So for those who wants to access Polymarket website in Singapore, unfortunately the VPN over here is blocked over here. Our web browser is being blocked at the moment to this website. So if you look at Polymarket over here, this is a slight delay, it's not live. So based on, okay, let me expand my screen so that you guys could have a better view of the chart. All right, so hopefully it's expanded as large as possible. So right now, as of now, we are speaking Thursday, 5th of March, 2026. Iran chance that the percentage of chance that Iran will close the Strait of Hormuz in 2026, right now the chance has go up to 86.25% and is at the all-time high, surpassing the previous peak that was seen on the start of this year, this month, 1st of March at 71.95% over here. So that is where the first missile from rain into Iran from the joint attack by US and Israel, and right now it's surpassed into a higher high and an all-time high at 86% chance that Polymarket bets now has risen the odds that Iran will close the Strait of Hormuz. So the Strait of Hormuz is very important. Why? Because this is the most, we call it a oil flow choke point that significant oil supply from the rest of the world derive from. So if there will be a closure of Strait of Hormuz, oil flow to get to the rest of the world will get much more expensive. That means, i.e., to transport oil, it will get more expensive. To have oil going into the whatever respective transportation will also rose itself because the per barrel of oil will rise as well. And if you look at the bottom of the chart, will be the West Texas crude oil futures price action. It moved exactly in line since the start of this year with the amount of chances that Iran will close the Strait of Hormuz based on the trader betting price action behavior as compiled by Polymarket, which is a key prediction market over here. So if this rising bets that Iran will close the Strait of Hormuz keep on going to fresh all-time high or higher high, it will have a positive feedback loop on the actual West Texas crude oil futures prices. So that actually put a cap on the bulls so far that we see in today's Asia session on the S&P 500 E-mini futures and as well as the Nasdaq 100 E-mini futures, and in some form, some of the Asia Pacific stock market as well as we are speaking. So let us take a look at the price action of the Asia stock market. So we know that the Nikkei 225 futures is taking into account of yesterday's US price action, because the Nikkei 225 futures allows to trade on Goblex. Yes, they extend their rally in the US session yesterday. So after taking into account of the 5 a.m. cutoff mark, right now the Nikkei 225 futures is actually trading down to session low by negative 1.14%, taking into account of that firmer oil prices that you will have in the near future due to rising bets in the Polymarket prediction market, stating that there is a high chance right now of a risk of the Strait of Hormuz closure, inflicting higher oil prices that could be a damaging impact on the Japanese economy, given the fact that the Japan economy or the Japan itself is a significant oil net importer. All right, over here. what's interesting over here that is bucking up the trend is the Hang Seng indices over here, which is managed to stage a rally up by 1.46% due to this ongoing China 2 session, where this morning the top policymaker revealed their game plan for 2026. So later I'll share in a while time after I go through this Asia Pacific benchmark stock indices intraday performance. And that also has a positive feedback loop on the CSI 300, which is up by 1.42%, which is the benchmark China A shares. And the narrower China A50 index also up to session high by 1.36% over here. All right. And if you go down to the ASX 200, so the ASX 200, it's trading rather lackluster, almost unchanged at 0.28%. The Kospi 200 continues to see wild swing. Yesterday, they are down by negative 18% or 15% or so. Today, they managed to claw back some of the gain, up by 10.6% over here. The Straits Times Index is up by 0.8%, given that the Straits Times Index has a strong correlation with the performance of the China A50 index, and also given the fact that the Singapore economy has a direct intertwine or direct, we call it a closeness with the Chinese economy in the last 4 to 5 years. All right. So over here, let me share with you what has taken shape in this China 2 session. Is pretty key towards the China A50 index, the CSI 300 index, and in some form the Singapore stock market, and as well as the Hong Kong stock indices, given their economic closeness with one another in the last 4 to 5 years. So the China 2, the China 2 session has just gone underway over here. So let me share with you so far what are the key highlights. So it's live over here right now. So China top policymakers for this year 2026, the goal has been reduced to 4.5% to 5% over here. So this is the lowest GDP growth target since 1991. All right, since 1991. All right, so what it means that there is a potential rebalancing going on in the Chinese economy. So we know that in post-COVID, right after post-COVID, 2021, Chinese economic growth has been pretty much driven by exports, all right, over here, less than a domestic consumption. So with a reduction of 4.5% to 5% this year, lowest since 1991 in terms of GDP growth target, it means that the China top policymakers in their thinking is strategizing to move away from a export-oriented economy. That means they do not want to rely so much on export, allowing export taking a backseat, but however, promoting other segment of the economy over here. So what's interesting over here is that during President Li Qiang's speeches, which is the Prime Minister, as he spoke about 1 hour ago, he pledges to bring back prices into positive territory. So he finally acknowledged this subtle acknowledgement of deflation, a somehow taboo topic in China. But during this top leadership speech over here, he actually mentioned this about deflation, and he pledged to bring prices back into positive territory and even call for a modest rebound over here. So this modest rebound is a rather a significant wording, because last year he did make this comment about modest rebound. That means in last year 2 session, Li Qiang did mention about modest rebound. He only called prices to get back to a reasonable range. So it seems to us that the China top policymakers, one of the key strategy that they have over here is to call for a modest rebound in the CPI inflation trend. That means they do not want the inflation, CPI inflation, to slip down into a deflation mode, indicating this as a key pillar of part of their new 5-year economic policy. So that actually also indirectly mentioned that there could be some form of consumer, or putting away that there could be some form of stimulus boosting domestic demand, because in order to see modest rebound in CPI trend in China or inflation in China, consumer got to spend. Once consumer got to spend, businesses are able to raise prices as accordingly. All right, over here. And also some other highlights to take a look at. Okay. Okay, some more highlights. All right, so let me share with you. There's this little table here. Yeah, this is the one. All right, so this table is the main target that they have. Right, so this is what it means, that it reduced the GDP growth target to 4 point, come on, yeah, let me expand it, yeah, to 4.5%, I can't hide, to 4.5% to 5% from around 5% last year due to economic rebalancing. The rest of the target still remains the same, so I want to push a highlight, especially on the headline budget deficit. So headline budget deficit, this is at a historical high of around 4%. So they will still continues to actually be in a, what I call that, targeted expansionary fiscal policy for China, all right, by having the headline budget deficit to be at a historical high level of 4%. And in terms of the issuance of bonds, still remains the same at 1.3 trillion yen for ultra long special sovereign bond. Local government special bond issuance will be still at 4.4%. And they actually targeted to create new urban jobs over 12 million. So I would say that it's still a rather targeted expansionary fiscal stimulus plan with the emphasis of rebalancing on the economic growth. That means they want to move away from an export-oriented economy implied by lowering their GDP growth target to 4.5% to 5%, given the fact that in the last 5 years post-COVID, majority of the growth has been driven by the export sector. So by reducing it to 4.5% to 5%, and with Li Qiang pledge of making inflation to rebound to modestly rebound over here. So where was it? Yeah, this one. He pledges to bring prices back to positive territory, which will be for modest rebound, as his wording that's being made up publicly, that put emphasis on the China top political mindset to potentially jumpstart consumer spending. So that actually allows the China stock market and the Hong Kong stock market, and in some form, economies that are related directly to the Chinese economic growth. Singapore will be one of them, for their respective benchmark stock indices to post modest gain in today's intraday Asia session. All right. So now, next thing I want to share with you guys over here is that with higher oil prices, we now start to see a risk of the inflation expectation in the US to rise, right, to continue to go up over here with the rise in US oil prices of US West Texas crude oil. So take away that this 10-year US break-even rate, which is in light blue, and the 5-year US break-even inflation rate, for those who actually follow my daily dose, these two rates over here are based on tradable price action on the US Treasury protection bonds, which means that this rate itself, the 10-year break-even at 2.3% and the 5-year break-even at 2.5% on the average, is viewed as what is inflation trend will be in the US 5 year from today, and what is the US inflation will be from 10 year from today. So if this forward looking, so if this forward looking inflation break-even rates continues to rise due to the higher oil prices, like what they did earlier in the past of 2021 to 2022, over here, look at the green line, which is the West Texas crude oil, and the dark blue and the light blue line, which is the 10-year break-even and the 5-year US inflation break-even. They actually rise in tandem, all right, over here, due to the onset of the onset of the Russia-Ukraine war at the point in time. So if this scenario continues to play out right now, going forward in the next couple of months, that could see inflation expectation shooting up as well to beyond, let's say, about 2.5% to 2.6%. And that could actually put the US Federal Reserve current interest rate cut cycle to be in a very tight spot and to be in the obstacle. So that has already been priced into the CME Fed Watch 2. So like I share with you guys right now is that the next interest rate cut in this ongoing interest rate cut cycle that kickstarted late last year. So last year, the Fed cut rates by three times. So now market is looking for when will be the fourth cut to come in. So the fourth cut to come in this year has been pushed down the calendar further down the road. All right. Previously, before the US-Iran war intensified over the weekend, market is looking at June. Right now, June has been greatly reduced to almost, I would say, no cut, right? Because market is only looking at 39% chance, 60% chance that will stand pat in the June meeting, 17th of June meeting. And previously, there was a high chance about what, 80%? That has been greatly reduced to 67% chance as well for the June meeting, for the July meeting, pardon me. So right now, the summer months has been reduced for the next interest rate cut, for the fourth cut. So this fourth cut will only come into after summer, autumn, September, October. All right, so September has a higher chance of 90%. Then thereafter, we will start to see a 71% chance during winter. That means on the last meeting of the year, which is the 9th of December 2026, 71% chance for the fifth cut to come in to bring the Fed funds rate down to 3% to 3.25%. So you realize that as oil prices continues to go higher and higher, the chance for the US Federal Reserve to ignite another interest rate cut, or we call it the fourth cut for this year and the fifth cut, this has been pushed down the calendar. Probability is still there, but it's been pushed down the calendar down the road. That means instead of the summer months, now we are looking at what, somewhere around the September, but market is still looking at least 2 interest rate cut by the time 2026 ends, because market is looking at 3% to 3.25%, and that is a 71% probability. But if oil prices are going to rise, all right, let me pose a question, rise, and also if we were to look at what has the events that has taken shape based on the Polymarket bets, all right, like what some Polymarket bet plays, high chance that the Venezuela leader will be removed. Indeed, it got removed. High chance that US will attack Iran before end of March, which is indeed. And now Polymarket bet placing a high chance of 86% chance that Iran will close the Strait of Hormuz in 2026. All right. So if this were to take hold, indeed, based on the bets on the Polymarket, it could create further oil price rises. And when that happens, this Fed funds futures bets will be greatly reduced as well, and perhaps there is a risk that we may see even no interest rate cut by the Fed this year. All right, so that could create a negative feedback loop into equity prices, especially in the US stock market, that is still ignoring it right now. So something for you guys to actually take note of, all right, in general. All right, so with that, that ends the first segment of the Daily Dose. Okay, let me now move on to the second segment, which is the intraday technical outlook segment, right over here. So with that, let me expand my screen. Okay, so let's start with the FX market. Okay, so before I jump into the euro dollar and sterling dollar, let's have a quick look at the US dollar index. So the US dollar index previously broken above the 200-day moving average, also broken above this descending trend line that previously kept the gains since 21st of November, 16th of January over here. And in today's Asia session, after yesterday's minor drop of negative 0.3%, in today's Asia session, it managed to stage a rebound of 0.17%, right exactly at the pullback support of this former descending trendline resistance, as you could see on my screen over here. Right, let me expose it. So net overall, it could still form some form of rebound to revisit this 110, 150 major range resistance that the US dollar index has been trading since 29th of May last year. So that's close to about what, 11 months or 10 months or so range. Okay, so it means going forward, at least in the near term, there is some US dollar pair that could still show strength of the US dollar, but some pair may show weakness instead. So later I'll share you guys what do I mean by that. So if you were to look at the euro dollar pair over here, so the euro dollar pair managed to stage a bearish reaction right now as we are speaking, right exactly at our pivotal resistance after this rebound. Can't see any we call it push up above the 200-day moving average, which is also our pivotal resistance that we have yesterday at 1.1673. And if we were to look at the trend line support itself from here, okay, it's now attempting to break down from this minor descending trend line on the intraday hour basis as we are speaking at 11:30 a.m. Singapore time. All right, so let me take a sip of water. All right, at 11:30 a.m. Singapore time, breaking down below, doing an intraday break below this parallel ascending, doing an intraday breakdown below this key minor ascending trend line taken from the low of Tuesday Tuesday US session. All right, so indicating that whatever rebound that we see so far is a dead cat bounce below this pivotal resistance level on the euro dollar, and also the RSI giving a very clear bearish pre-breakdown. All right, much clearer bearish pre-breakdown, right, indicating that downside momentum has resumed. So no change, looking for a bearish bias view for the euro dollar for today as well. Continue yesterday's bearish bias view, 116.73 as my short-term pivotal resistance level. First support level to watch will be Tuesday swing low area, minor swing low area at 115. Okay, 115.65. Below 115.65 exposes the next intermediate support zone at 114.95/114.70, which is the 1.382 Fibo extension on this ongoing corrective decline from the high of 28th of January. And if you go back in time, will be the minor swing low area of 21st of November and 5th of November last year. Only a squeeze up and an hourly close above 116.73 will invalidate today's bearish bias view to see the rebound extending further towards the 50-day moving average and converging very closely to the downward sloping 20-day moving average as well, with the next intermediate resistance zone to come in at 117.40/117.74 next. All right, so that's for the euro dollar. Next up will be the sterling dollar. So sterling dollar also reacted negatively from our from our rather tight pivotal resistance that we have yesterday. A bit of excess at 134.04. So I'll be using 133.72 with the excess level at 134.04 to maintain my short-term pivotal resistance level. Bearish bias for today, first support level to look out for will be Tuesday swing low area 132.65. Breaking down below it exposes 132.20 next, okay, which is the lower limit of this bearish medium-term descending channel in place since the high of 28th of January, and also the 1.382 Fibo extension as well taken from the high of 28th of January. And you go back over here is the minor congestion area of 2nd of December last year. However, a squeeze up above 134.04 will invalidate today's bearish bias view to see a further recovery/rebound towards 134.50, the 200-day moving average as well. Above it, seek out the intersection between the 20-day and the 50-day at 135.23, also converging very closely with the upper limit of this medium-term descending channel drawn from the high of 28th of January. So maintain that bearish bias for the sterling dollar with an excess at 134.04 short-term pivotal resistance level. Okay, so still maintaining that bearish bias for the sterling dollar. Next up will be the Aussie dollar. So the Aussie dollar also did a choppy move around 70.70 over here. So previously we have 70.70 as our short-term pivotal resistance level, did a choppy move around it, and right now it reintegrate back below 70.70. So with that, I will have a neutrality stance for today. So it seems to me that it's being trapped in this neutrality range. Yesterday, it tries to break below 69.80, but before forming that rebound that surpassed 70.70. So using today's Asia session high, due to conflicting factors, I'll maintain a neutrality stance on the Aussie dollar. So neutral between 70.80, 80, 88, 70.88, 70.88, and 69.80 over here. So only a bearish breakdown below 69.80 may open up scope for further weakness to revisit or retest the 50-day moving average that is converging with the next intermediate support zone at 69.05, 68.90. All right, over here, which is the former gap up that is being seen on the 26th of January and the 6th of February swing low. So that's for the Aussie dollar, flipping to a neutrality stance between 70.88 and 69.80 for today. Next will be the dollar yen over here. So the dollar yen managed to broke down below this parallel ascending trend, minor ascending trend line support from the low of 17th of February. Now turns into a pullback resistance level over here. So still hitting our first support level, which is at 156.83. Right, 156.83. Okay, let me go it. Okay, so right now it's going above it. Okay, so right now 157. Okay, so now it's at the pullback line over here. So let me extend this. 157.20. Okay, so right now it's trying to do a bearish reaction as we are speaking right now at 11:35 a.m. Singapore time on this pullback resistance of this former minor ascending trend line from the low of 17th of February that got taken down at 8 a.m. Singapore time today. So using a Titan adjusted short-term pivotal resistance for today at 157.20, maintaining a mild bearish bias view on the dollar yen. Next intermediate support level to watch will be 156.17, which confluence with the 50-day moving average. Breakdown below 156.17 exposes 155.42 next, which is the conversing with the 20-day moving average as well. However, a breakup above 157.20 will see it retesting the medium-term pivotal resistance area at 155.50, 157.5. Above 157.5, we'll see a further squeeze up towards 158.30, even 158.90, 159.23 next, which is the minor swing high area of 23rd of January and the swing high area of 22nd of January and 23rd of January as well. Over here, this zone, previously at 12 p.m. Singapore time at that point in time on 23rd of January. So that's for the dollar yen. All right, and also sum up all the intraday technical outlook on the four major US dollar pair. Pretty much of a mixed bag, I would say. Now, starting with the global stock indices, with the Hong Kong 33 over here. So the Hong Kong 33 yesterday, we are looking for a residual push down towards this level at 24,765. It seems to us that the residual push down dematerialized and price action now recapturing the 200-day moving average. Right, so that right now there could be some form of a minor recovery back towards the upper limit of this ongoing medium-term descending channel that has been in place since 23rd of January. All right, which is so confluencing with the 20-day as well, and the 50-day moving average very closely, slightly below it. So because I do not want to put it so tight, so perhaps what I could do is I could have the first support level to look out for. Over here, which is yesterday's US Asia session swing low, 25,060 over here. But pivotal support level would be my long-term pivotal support at 24,765. So using 24,765 as my pivotal support for today, flip to a mild bullish bias stance on the Hong Kong 33 with the next intermediate resistance coming in at 25,960. Followed by 26,350 next. However, if price action punches below 24,765, then this recovery will be in jeopardy where the Hong Kong 33/Hang Seng Index may show further weakness to expose the next support level at 24,257 and even 23,845, 23,680 further up, which is the swing low of 4th of July and the conjecture area of 23rd of June last year. Okay, so that's for the Hong Kong 33, flipping to a mild bullish bias for today. Next up will be the Nikkei 225, the Japan 225. So the Nikkei 225 reintegrate back below our pivotal resistance where it did a bit of whipsaw above the US session yesterday at 56,530. So I will tolerate the excess over here. Okay, to 5300 over here. So 56,096/530, that will be my short-term pivotal resistance zone to look out for. Maintain that bearish bias for a retest at that medium-term pivotal support zone that managed to survive yesterday, 54,100, 52,960. Breaking down below 52,960 may offer further weakness on the Japan 225, representing the Nikkei 225 towards 52,960, 52,260 next, which is the swing low area of 6th of February and the swing low area of 21st of Jan to 26th of Jan at 52,260. All right, only a squeeze up above 56,530 that will invalidate the bearish view to see a recovery towards 57,140 in first step, followed by 58,140 next. So 57,140, 58,140. All right, so that will be the recovery resistance level to watch on the Japan 225 for today if 56,530 is surpassed to the upside. All right, next one will be the Germany 30 representing the German DAX. So the Germany 30 reacted off exactly at our pivotal resistance at 24,300 level as we have yesterday, and also now trading below the 200-day moving average. So still maintain that bearish bias view with two key short-term support level to watch on the intraday basis for today. Firstly at 24,080, which is testing it right now at 11:40 a.m. Singapore time. Breaking down below it, we'll see the swing low area that was being seen at 2 p.m. Singapore time yesterday before the start of the European session at 23,750. And below 23,750 may see a lower low towards 23,480 next, which is the minor swing low of 1st of December that confluence with the congestion area of 21st of November and 26th of November last year. However, a squeeze up and an hourly close above 24,300 short-term pivotal resistance will invalidate today's bearish bias view to see a recovery towards 24,600, followed by 24,740 next. So that's for the Germany 30. Next will be the US Wall Street 30 representing the Dow Jones Industrial Average. So it did a bearish reaction right exactly at the 48,775 short-term pivotal resistance that we have yesterday. A bit of excess at 850 level. So I'll just slash it to 850. All right, and what you could see is that the hourly RSI is now breaking down below a parallel trendline support level as well, and also breaking down below the 50 level mark, okay, indicating the return of bearish momentum on the intraday basis. So with that, still maintaining the bearish bias on the US Wall Street 30 representing the Dow Jones Industrial Average for today, after yesterday rebound got exhausted at the pivotal resistance area with the excess at 850. So 48,775/850 short-term pivotal resistance for today. First support level to watch 48,208, which was yesterday's European session low. Below it, we'll see a retest at the medium-term pivotal support area at 47,860, 47,760 in first step. Below it, we'll see another leg of bearish impulsive down movement towards 47,350, 47,270, which is a 1.382 Fibo extension target from the high of 10th of February. And if you go back in time, it's also the congestion area of 2nd of December, confluencing with 17th of November. However, if we start, okay, give me a minute, let me go back. Okay, however, if we start to see a squeeze up above 48,750, then this recovery will extend further towards the 50-day and the 20-day moving average, confluencing with the next graphical intermediate resistance at 49,079, 49,360. All right, so that's for the Dow Jones Industrial Average, still maintaining a bearish bias view. Next, S&P 500. So the S&P 500 also did a bearish reaction of the 20 and the 50-day moving average over here and reintegrating back below 6,868 over here. So with that, I'll still have this bearish bias view, ignoring yesterday's squeeze up as it staged a bearish reaction of the 20-day moving average. And also the hourly RSI has now started to stage a bearish breakdown below a parallel ascending trendline support area itself, indicating the return of bearish momentum. So with that, using the 50-day moving average, which confluence at 6,907, 6,919, that will be my pivotal resistance zone for today, to have a bearish bias view, to see a retest back below European session low yesterday at 6,785. Below 6,785, we'll see a retest at the medium-term pivotal support area of 6,733, 6,720, which is considered as my range support level as well. That has been in play since the low of 18th of December last year. Okay, so this is the bottom of the range, right? In this ongoing so-called 2.5 months of quite choppy sideways range configuration. However, a clearance above 6,907, 6,919 over here, 600,919, that will invalidate today's bearish bias view and see a squeeze up towards the top of the range. In first instance, retesting the minor descending trend line that has been in play since the high of 28th of January at 6,972 next over here. Next will be the Nasdaq 100. So the Nasdaq 100 also did a squeeze up over here, but it can't break above the 50-day moving average and did a bearish reaction today, as we are speaking right now at 11:45 a.m. Singapore time. And the hourly RSI also starts to shape this bearish breakdown as well. Okay, bearish breakdown from this parallel ascending trend line as we are speaking at 11:45 a.m. Singapore time, indicating the return of bearish momentum for it to trade back down towards the range again. So what I could see over here is that it has been in the 1 month plus of minor range configuration since the low of 6th of February, trading in this kind of very choppy sideways range, and is now approaching the top of the sideways range, which is at 25,377, 25,430, which is also confluence slightly below the 50-day moving average, where price action can't break up since its breakdown on the 4th of February as it going into this minus sideways range configuration. So using the upper limit of this sideways range configuration as my pivotal resistance for today, or short-term pivotal resistance zone, 25,377, 25,430, maintain that bearish bias. Two support level to watch out for today will be this former minor swing high turns into a pullback support at 24,774. Then thereafter, breaking down below 24,774, was revisit yesterday's European session low at 24,500. Right, 24,500. The first step. Right, below 24,500, we'll see further weakness towards 24,333, 24,140 maximum. So that will be the medium-term pivotal support that also confluence in the area of the 200-day moving average, and also the lower limit of this range configuration that has been in place since 6th of February. However, if price action starts to see a squeeze up above 23,430, then we'll see a bullish exit of this range for it to test the next intermediate resistance level, which is the minor swing high of 30th of January and 3rd of February at 25,940 next. So still maintaining a bearish bias view for the Nasdaq 100 in this rather choppy sideways range configuration, as price action on the hourly RSI stage a bearish breakdown, indicating the return of a bearish momentum to see a mean reversion down back towards the lower limit of the range. All right, so that will be the Nasdaq 100. All right, next will be the commodities market, starting with the gold XAU/USD. So gold XAU/USD continues to be held above our pivotal support yesterday, tracing out a series of higher low, you could see over here, which is positive. So still using the same pivotal support that we have yesterday, 5,046, which confluence with the 20-day moving average, maintain a bullish bias as it's going to recover after last Tuesday's sell-off. First support level to watch, 5,280, no change. Above 5,280, we'll see a retest at 5,448, which is the 30th of January 2026 minor swing high over here. All right, bearish breakdown below 5,046 and the hourly close below it will invalidate this recovery scenario to see a further push down towards 4,960, maximum 4,842, which confluence with the rising 50-day moving average. So that's for gold XAU/USD. And lastly will be the West Texas crude oil. So I will see is that this is the daily chart of the West Texas crude oil. 4 consecutive sessions of intraday gains. Today up 1.44%, looking to surpass the intraday high that is being printed on 3rd of March, which is Tuesday high at 78.06. Rather strong positive price action movement on the West Texas oil. So with that, let me share with you guys over here. So this will be the daily chart, the hourly chart of the West Texas oil as it continues to trade within this minor ascending channel that has been in place since last Thursday, 26th of February low. And what you could see over here is that the hourly RSI has now started to stage a bullish breakout from a parallel descending resistance over here. So with this bullish breakout on the hourly RSI, there could be a chance that it could break above 78.10 over here. So with that, I will use yesterday's low, which is my first support level at 78.38. Indeed, it got survived. And this 73.38 also confluence with the lower limit of this ongoing minor ascending channel. So with a positive observation on the hourly RSI, which I explained to you guys earlier, indicating a continuation of the build-up of positive momentum, adjust the pivotal support today to a slightly higher level at 73.38, which was also yesterday's minor swing low where it survived. Maintain that bullish bias on West Texas oil for a potential bullish break above this week high, which is Tuesday high at 78.10. Above 78.10 exposes 80.30 next. Above 80.30 will potentially seek out the next intermediate resistance at 83.60, 84.55. 0.368 Fibo extension of this ongoing bullish impulsive up move since the low of 17th of February, and also graphically the 2nd to 18th of July 2024 swing high area as well. Only a bearish breakdown below 73.38 will negate the bullish bias direct view to see a minor corrective pullback to retest the former 1st of August 2025 minor congestion area, and also this Monday gap up at 69.26/67.80, also confirms very closely to the rising 20-day moving average. So that's for West Texas oil. So all right, so I've covered all the intraday technical outlook on the broad base across asset classes. So before we go, let's have a quick look at the economic calendar. What are the key data to look out for other than the Iran-US ongoing war that is still showing no signs of ending for now? All right, so today will be the Thursday, the 5th of March. So let me take you through the calendar. 5th of March. All right, so at the start of the European session, nothing really interesting to be taking note of. Because this PMI data is not really that interesting. It's a construction PMI data. So we have ECB official speaking, Gandios at 4:50 p.m. with tier 1 data retail sales, okay, at 6 p.m. Singapore time. So market is expecting a slight rebound to 0.3% for the month of January year-on-year, month-on-month. And for year-on-year, also a slight increase to 1.6% year-on-year in January from December print of 1.3%. So that will be 6 p.m. Singapore time, and it could influence the euro dollar, the euro crosses, and in the Germany 30 CFD index over here. And at 6:45 p.m., we will have ECB Donatory speaking, an official speaking over here. Then going forward, in the US session, we have the tier 2 labor market data, which is the weekly continuous jobless claim data at 9:30 p.m. Singapore time. So the continuous jobless claim data, market is expecting a slight increase to 1,850K jobs added over here from 1,833K jobless claim added. Okay, so the higher the number is indicated there are more jobless claims. So more jobless claims indicate that the labor market is still soft over here. So that could potentially influence the major US dollar index and in some form the major FX dollar pair. So that will be at 9:30 p.m. Singapore time, a tier 2 labor market data for US, which is the weekly continuing jobless claim. It tends to be rather volatile over here. And with that, that pretty much sum up the US session. So at 1 a.m. Singapore time, early Friday, we have ECB President Lagarde speaking. And before we kickstart the daily dose on Friday. Okay, so not much. Okay, so there'll be no other key data in the Asia session. All right. So with that, let's sum up today's daily dose of market insights. Kelvin here signing off. I wish you guys a great day ahead, and we shall speak again tomorrow. Thank you.